Mm. Hi, folks, welcome back. So we're going to be looking at the summary of week ending March 28th, 2025. Now, I'm not going to do every day, obviously, because I do what I do on X and on the Telegram channel. But the NASDAQ, if you take a look at this is our June 2025 daily chart for NASDAQ futures. And if you recall, watching last week's weekly summary video, if you haven't watched that, it's beneficial for you to go watch that first before watching this one. So if you look at the daily chart, we mentioned that this area right in here, we thought that we could trade up into that here and then reject that and trade back down and reach for this low. Now, I was incorrect in the sense that I was off by a couple handles because it didn't get to that low. But overall, it was pretty good, close enough for government work. So let's kind of like break this down a little bit. Inside of all these wicks in here, I mentioned this in the Telegram channel. When you're looking at price action, it's doing things like this, and we have traded below it, but we're still remaining bearish. What I like to look for is inside that area of long-legged shadows or tails on the candlesticks. Now, above the high of the candle, that's usually called a wick, but down below it, tails, shadows, whatever you want to call it. But when the market trades lower and I'm bearish, I like to know where the consequent encroachment is on the longest of the wicks. If there's multiple wicks in here, or in this case, tails, that's this one here. So if you look at that range from the open down to the low of it, half of that's consequent encroachment. If you note that and draw that out in time, you'll see that that's pretty much as far as the market's going to trade to. Now, if you don't know this concept that I've been teaching for a while now, it's something that you should go back and look at your charts, find it in hindsight, collect lots of examples of it, and you'll start seeing the foundation to my gray pool areas where it's a PD array that's using the wicks themselves. And two or more consequent encroachment levels could constitute a gray pool. So while that's not the case here, it's just simply a consequent encroachment mid tail or shadow of this longest legged candlesticks formation here with that below the opening price. It's above that volume imbalance that I mentioned last Saturday before we would get to that premium wick consequent encroachment. Now, why am I calling it a premium wick consequent encroachment? Because the market's down here and trading up to it on Tuesday, Wednesday, then it falls out of bed and aims towards that low I mentioned that we would likely do after getting up into that area. Okay, so the initial draw was this volume imbalance, but because the market is volatile and it can trade through it, it trades to it and to the consequent correction of this long-legged candlestick, doji type formation underneath it. In this area in here, I want to talk a little bit about options. Now, it's going to be a soft rollout in this conversation because it's going to be a very short video. And in the past, you've heard me say things like that, and I end up going for a long, long time. As of right now, I'm not in the, I'm not able to do that. So we'll have to just do the small videos and be content with that still. But the run up into this volume imbalance, and as much as that premium wick consequent encroachment, if we were to anticipate that very run down here. Now, I hope I can talk like this now because I outlined it before it happened. So last Saturday, I mentioned that we would draw up here and then reject and trade lower to go back below this low. That remains to be seen if it happens on Sunday's opening trading into Monday transaction. But assuming that this was something that you wanted to navigate, there are things that we can do that are outside the futures market and the CFD market, and it involves the options market. So, one of the things I like doing, and what I used to do as a younger man, was look for weekly option plays. And that means that if I can predict real close, it doesn't have to be perfect, but this was the number one reason why I was wanting to know what the weekly high and the weekly low would likely be, because I could take an opportunity and trade options with it. Now, originally, when I first started, I was interested in buying very, very cheap, undervalued options and hopefully see them balloon up in profit. And I found out quickly that I wasn't that good at that. And my very first trade, and many of you that's been following me for a long time know that my very first trade was a losing trade where I lost half of the amount of money I put up for the premium of an orange juice option. I spent $1,500, and overnight I lost to $750, a little bit more than $750. And that was a very jarring event for me because back then, as a 20-year-old, $750, I wasn't even making that in a week gross before taxes taken out. So it's it was something that hurt me, but eventually I started thinking to myself, somebody made that $750 and they made it overnight. So what were they doing? Well, they were writing the option that I purchased. So I was going in and buying an outright long option. And then the market itself said, no, you're wrong. The very next day, the market opened up and the option value fell out of bed to the tune of 50% or more. So the option writer, the person that was on the other side of the transaction that sold the option for me to purchase, they were able to collect a premium increase in their equity on the trade, but the value of the option diminished. So they were shorting the position that I purchased the long option on. Said in a different way, in simpler terms, let's assume for a moment that you felt that the NASDAQ futures should go to this area and then trade lower. You could trade the SPX option market. And I know a lot of you like to trade the SPY, but the SPX is actually a little bit better. You have a lot more options in terms of the strike prices. And what a strike price is the determination of what value the option is going to be based on. So, for instance, if we were looking at the market likely trading up into this area and then becoming bearish the rest of the week, we could look to sell call options above this area here. Now, I'm not suggesting that we're going to do this with NASDAQ futures options. I'm suggesting that if you're interested in this, and I'm only going to spend a couple weeks on it because I don't think that it's for everyone, but I have mentioned in the past where I will cover how I used to do it when I was a younger man. You can take a small account and parlay it up over time to a point where you could carve out your own living with it and never do a whole lot of trades. You're looking for one really good setup per week, and you're holding the trade for about a week or so, and then you're getting out. You're not trying to get rich on every single trade. You're not trying to make your options go 5, 6, 700% increase all the time. You're just trying to double your money, maybe get a double. If you're lucky, get a triple. But you don't even need to have that sometimes. If you just get a single, one for one, that's in itself many times what's potentially more than you're probably earning at your job. So I kind of like want to toss this out there, and I want you to think about how when we're looking at these higher time frame daily moves, when we're spending time on these time frames, when there's a likely intermediate term or long term high or low forming, that presents this very opportunity where we can sell the option. Now, let me make sure you understand this clearly, because the writer of the option has a whole lot more risk than the purchaser of the option. So, for instance, let's say that you were going to, and let's say this is the SPX market, the cash market for S&P. The idea would be that you're trying to pick a strike price above where you think the market's going to turn and start trading lower. Now, ideally, if the premiums, like the put the call ratio and options tools that suggest when there's an overvaluation or an undervaluation, and I'll talk a little bit about that when we get into it next week with a little bit more detail. But for now, I want you to think about how you might be interested in seeing the opportunity of selling call options. Now, a call option is the right, but you're not obligated to buy the underlying. And that means if you're selling call options on SPX, what you're saying is you're giving the opportunity for someone that wants to buy a long call option. And if they buy it and it goes up, they potentially have the right to exercise that and purchase it, but they're not obligated to exercise the option. But they have a limited risk, meaning that whatever they paid for the option itself, that's the most plus the commission costs. That's the most they could ever lose on the transaction. You, on the other hand, don't have that protection. You have a little bit different risk paradigm there. So I want you to think about how there is absolutely inherent risk to this, but when the market's predisposed to go higher or lower on an intermediate term basis, what do you think that purchasers of call options above these highs on Tuesday and Wednesday of this week that just passed, how do you think they feel right now when we're just sitting way down here? Their call options are becoming cheaper. They're getting less likely to be profitable. And with the effects of like theta and time decay, it could really be diminishing over the course of just a few days. So with that, I want you to take a look at how the market has traded on a weekly and daily chart. And you're framing these types of setups on those two time frames. So it's very, very higher time frame oriented for people that have jobs, that have a whole lot of affinity for wanting to learn how to trade, don't have a lot of money, but they don't have the ability or time or the luxury to go into intraday trading like I teach primarily. A higher time frame, working class hero type approach. This is kind of like what I was trying to do, because I was killing myself as a young man, working and trying to do this while I was driving around and taking great deals of risk, not paying attention when I was doing driving, because I'm looking at a little handheld device that was telling me real-time prices for the commodity markets I was trading. So I was entertaining ideas that would lend an alternative to simply being in there and trying to catch short-term trades, because I wanted to be like Larry Williams and be a short-term trader. He was my hero. He was the biggest influence I had in trading initially, and he inspired me to want to do what he was doing. And until I got good at short-term trading, um, I had a lot of adversities. So I started system hopping and changing strategies. And one of the things that I learned, that there was a guy back in the day called Don Fishback, and he had a 90% odds course on options. And of course, I went to Traders Library out in Columbia, Maryland, and every 2-3 weeks I'd save up money and get some kind of books or VCR tapes back then, and try to learn more about the markets and whatnot. Basically wasting my money, because I was chasing all kinds of things that just don't work. But his course on options trading really inspired me to try to think about how I could do that on a short-term trading basis with weekly opportunities, because I knew enough to know that on a daily chart, the moves that would transpire over the full week of Monday to Friday's trading many times offered opportunities where, if I was accurate in the direction on the weekly chart where it was going to go. And if it was going to spend 5 days or so moving away from the extreme of that weekly range, in this case, let's say that we knew that it was likely to go up to this area and we felt comfortable assuming the risk on the market going lower and not going any higher. And again, please permit me to say it like that because I did, in fact, call this last week. So it's not like I'm hypothetically saying anything here. I'm stating that if you believe that you're going to have this skill set in the future as well, you could write options. Now, the option writer is the person that is taking the option itself to the market and saying, okay, here's what I'm willing to take the other side of. And when there's a buyer of that strike price of that instrument on that very vehicle that you're trading on there, and we're going to be looking at SPX options is what we're going to be looking at. The joining of those two parties, the buyer and the writer. The writer, he or she collects the premium paid it immediately upon the transaction. So let's say, for instance, that you felt that, and then say this daily chart was not NASDAQ, but SPX, the cash market for S&P. If that were the case, and let's assume for a moment that the options above this high here for SPX, say that the options were valued at, I don't know, I'm just going to give you a ballpark number, and it may or may not have been accurate, but let's just say it's $500, okay, per option based on a strike price higher than that high. Now, I know some of you guys are already options traders, and you're probably listening to me talk about this, and you're thinking, well, you need to tell them this, you need to tell them that. There's a lot of you in here that are new, don't have any idea about what options trading is. I'm just giving you the underlying premise to what I was doing as a younger man. Okay, so you could collect the immediate premium paid by the option buyer. So there's people out there that saw it running up like that, got excited, and maybe thought, wow, it's going to keep going higher. So they buy call options. Now, if you're picking a strike price on an option, and a strike price, like say this is where we were trading at on Tuesday and Wednesday of the week, you could have the 600 level. That would be an example of like a strike price. Okay, and it's usually in SPX, it's every 5 handles. So the next one would be below it would be 595, and then 590, and then 585. But basing it on SPX, not NASDAQ. And I know some of you are thinking, well, you should be showing this on an SPX chart. I don't want to be doing too many things in this review. I'm worn out, I'm uncomfortable, and I'm trying to get through it as best I can. But if you were to sell those options by writing them, this is what you're doing. You're the underwriter of the option, basically. So the premium paid by the buyer of that call option, you get that immediately deposited into your account. Now, if you're wrong, that quickly evaporates. Okay, you could see very, very harsh debits to your account balance if you're really wrong and you're selling a lot of options. But premise is that you're trying to do one. Okay, you're going to start with everything in every endeavor. You're going to start with just one. So what you're looking for is an opportunity each week to sell one option, whether a call option or a put option. A call option is the right to own and purchase the underlying instrument, but you're not obligated to buy it. So you can walk away and whatever you paid for the option and plus commissions, that's your total investment. You cannot lose any more than that. And it's very intriguing. It's very enticing for people to want to do that. When you're purchasing long puts and long calls, and a put option is the opposite of the call, it means that you're likely to profit if the market does in fact drop lower than your strike price. Now, the easy way to remember it is call up, put down. Okay, so if you're bullish on the market, you can be buying in a long call. But if you are able to look at the marketplace and time when the market is no longer likely to be short-term bullish, like we had on Tuesday and Wednesday, call options were getting real interesting to street money, retail traders. They want to see a continuation on the upside. You see the people on CNBC, you read all the headlines in Barron's, Wall Street Journal, Investors Business Daily, and you read the article headlines by people that are in the industry saying, we're at a tradable low and we can come back into 50 to 75% of this price run lower. So when the public sees that, because they subscribe to the magazines, they subscribe to the newspapers and whatnot, they feel like they're informed. So yeah, they're going to go in there and say, well, it's been going up, so let me go and buy some call options on the market. At the time when we, as smart money investors, we're looking at the market, timing it with things that are not retail oriented. So when we're looking at the market like to go up here, like we mentioned last Saturday, just to go lower, we can wait for the market to get to that extreme when retail will be absolutely bullish and they will be interested in buying call options. But as a younger man, I would be interested in selling or writing call options to the marketplace. So that way I could collect the immediate premium by the buyers of the call option. Now they have limited risk. I don't have the same um, benefits of that. Like I could lose more than I made on the premium. Like it could be worse. It could be really bad. So what you're doing essentially is you're collecting premium by writing the option, and then as the market moves in your favor and against the underlying direction that would profit that call option, their premium that they paid will diminish, which means that you get to keep it. And then eventually, at some point when you're comfortable and you're able to do so, you exercise your side of the option by getting out of it. So you're exiting the trade. You have to buy one. Okay, so knowing this isn't going to be for everybody. I'm not going to spend a whole lot of time with it. So every Friday for the next 2 weeks, um, I'll talk about this as a strategy and how to build an idea of how you might want to implement it. I'm not going to do a soup to nuts. Do this, do this, do this. Step by step by step. There's a lot better resources out there than I would ever be in terms of options trading. All of the Greeks, if you want to get nuts about it. I try not to do all that. And in the beginning, as a younger man, I got really bogged down with wanting to know everything about every Greek and Greeks like the gamma, theta, all those things that are the delta. All these things are components to make up the pricing and the evaluation of an option. So, uh, for those that are very astute and academic, you can obviously spend a whole lot more time than I'm willing to invest in talking about it. But what I'm primarily introducing is an idea, a strategy that may or may not fit you. And because it may not fit most of you, I'm not going to try to drive it down your throat like I would be like a inversion fair value gap or an order block or model 2022 like or that there's an algorithm. Okay, I'm just loosely presenting something so that way if you want to pursue it, there's really wonderful resources out there. And then 2 Fridays from now, I'll give you my opinion of the option resources that I think that are viable. If you are going to purchase anything, I don't get anything from it. They're just like books or resources that we can go and look at it. But that I felt were good. And invariably, what will happen is people that are more astute with trading options um, in our community, they'll speak up and they'll say, "Well, this is what I use, or this is how I do it." And you might get some kind of a conversation going on with the other members in our community on X, and then that might lead to something in the future for you, or it's just a departure from what you're used to seeing here, and it's just something to break up the monotony of the standard ICT conversation pieces. So anyway, I want to talk about how we traded up on Monday into that volume imbalance, and then Tuesday we traded higher into the consequent correction of that wick, and then we broke lower on Wednesday, drawing right back down into this volume imbalance. Now, because the market is predisposed to go lower. We framed it with it likely being bearish, even if it trades back up into this area. We wanted to see it reject it. I think this would meet and agree with anyone's definition of rejecting. I went higher and it quickly. So see the time amount of candles it took for it to get there, and then how fast it moved away. That indicates extreme weakness. Now, because it's up here and it's likely to draw down to that low, how can we trade that and not need it to go to that low and lower yet? Because as you saw on Friday, I have a short position that was only uh, 2 ticks away from being filled or potentially filled. Getting out, it would have been the low of the day, but I was 2 ticks away from the daily low on Friday. And right now I'm over the weekend holding short for contracts. So my expectation is that because we went so hard on Friday lower, we're likely to gap lower than this low here. That's what I'm anticipating. Now, if we don't gap lower and we open a little bit higher, I'll look for it to trade down and then make another attempt to get below that low. Worst case scenario, it reverses on me, and then after a day or two, then it goes lower. That's, in my opinion, less likely, but it's always potentially there because I don't do a lot of holding over the weekend. But in this instance, because it was so likely to get down there on Friday, and I'll talk a little bit about after 4 o'clock p.m. in a moment, but because it's shown its willingness to be so heavy and really no interest in going higher, and it quickly repelled that levels up here. This volume imbalance, I would have never expected to create some short-term low to trade back up. Why? We're weak. We're likely to take out that low here. We have relative equal lows. That's going to be a real quick draw. And then look at this single candle here. And then we had this big down candle here. This is a balanced price range. So it's not likely after creating this candle here, it's not likely to trade back up in this area and treat that as a fair value gap. It's likely to just continue going lower. And going lower it did. And then fell just short of getting right below that low. Now these levels down here, probably looking at them wondering what they are. What I've done was I put a Fibonacci on the highest bodies and lowest body and had projections ran. Okay, and you know what those projections are. But if we get below here, this is the minimum expectation I expect to see. And this is kind of like the perfect scenario for swing trading. That would be a perfect level for me to be content with if it was to trade down there. Now, I'm not going to hold my position that long because of the market's volatility, because of all the saber rattling, the issues with Canada, the tariffs, like all kinds of things are going on. I don't want to hold, and to be honest with you, I don't feel all that comfortable holding over the weekend. But I felt inclined to do so because I felt it's not a lot of risk. 4 contracts isn't a terrible amount of leverage, and it's, in my opinion, likely to just gap lower than that low. Okay, and whatever the first print will be on Sunday, if it's lower than that, then I would expect to see that's where my fill would be, and then it would be better than what I had my limit order set at on Friday. So let's break this down a little bit further. Here's an hourly chart. You can see we traded up into that premium wick consequent encouragement on the daily chart. Then we had a lot of displacement lower. We opened on this candle, came right back up to that original draw on liquidity, which was that volume imbalance. Okay, so I only gave you 2 PD arrays on that daily chart so you can track and maintain your awareness or keep your bearings in where we're at in price relative to the daily chart. All the way over here, we see those relative equal lows that I mentioned on the daily chart. There's sell side below that. And then we had another one here on the hourly chart. You can see real clear. Now I've made them slightly faded so that way you can see that we did trade to it, but this is the one that's active now. Okay, so this was the volume imbalance on the daily chart that once we moved away from, it would draw down into that. Notice how we did that very thing here to consequent encroachment, which I'm not going to measure, and you can do that on your own chart. And we trade right back up into this inefficiency right here. See that? Now it trades outside of it a little bit there into an area that's a balanced price range. So this candle's open to its high, and this candle before it, all that price action back and forth, hits it, stops, and goes the other direction. We have the market trade back down. And then once we get down below the midpoint of this area here, it has difficulty doing what? Going any higher. And it breaks lower. Then we have this sell side imbalance, buy side inefficiency. Trades up into it there. And then it's off to the races we go. Go, go, go. And then sell side taken. Once we took out these lows, it had a lot of heaviness, meaning that it was more likely to continue lower than any consideration as a retracement. There's no need for it to go there. It's in a hurry to get somewhere. Where is that? These old daily lows here. So if we look at how we traded and got right to the close, it was so close. I felt that we were going to at least give me my fill, but it denied me, and that's sometimes what's going to happen. We'll drop down into a hourly chart, same time frame, but we're breaking the days up with vertical lines showing you Mondays, Tuesdays, Wednesdays, Thursdays, Fridays trading. Notice how we had essentially a market maker sell model. Okay, original consolidation, smart money reversal, low risk sell, distribution, redistribution, and then the second leg is the most aggressive to the downside. 15-minute time frame. Here's that blue volume imbalance. And now because we went below it and we're bearish and we're aiming for this low down here and that original relative equal lows on the daily chart, we're going to divide that range up here in quadrants. And now it's going to act as an inversion fair value gap. Okay, so once we leave the upper half and come outside on a closing basis, notice we don't have a closing basis there. It trades outside of it. That's just like I call that a mohawk. It's just like coloring outside the line. Like if you have a child and they color a picture for you and they show, here you go, mommy, here you go, daddy. You're not going to look at your child and say, look at you, you fool. You didn't even stay inside the line. You're not going to do that. It's a treasure to you. Well, this coloring outside the lines is permissible. We anticipate those types of things happening. But when it does close outside of it, we're then going to watch, does it return back inside of it? And does the lower half maintain price? And does it stay outside of the upper half? As you can see, that in fact is what we have. And then we leave it here, we have a displacement. This first fair value gap, this is exactly how I teach my inversion fair value gap. Okay, this is the easiest application to an inversion fair value gap from ICT. That first fair value gap that forms after breaking away, validating the inversion fair value gap. Once that forms, trading up into it there, perfect. That's exactly what you're looking for. And you place a stop just above consequent encroachment. That will be your underlying risk. Now, that might be incredible in terms of risk for you. Well, that's unfortunate because there are micros. And a lot of you don't want to touch a micro because you think that that's somehow like a uh, size matters type thing. Like, you have to only do a mini contract or you're not a real man. You're not a real professional trader unless you're using minis. If you use a micro, you're somehow substandard. No. You use the micro to facilitate the trade and you manage risk impeccably. That's what the micro is there for. It's not uh, a distinguishing vehicle between the pros and the neophytes or novice traders. I have students that are doing very, very well, and they're doing it just with micros, and they don't ever touch a mini ever, and they don't have a job. That's all they do. So for the people that are very opinionated, chances are they're working at Jiffy Lube while they're talking like that. So the fair value gap that forms after the validation of the inversion fair value gap, that's when you want to start your position. And then any opportunity you can add to it, you can do that. So the market does, in fact, break lower. It trades down to the first relative equal lows on the daily chart. There's sell side there, and it consolidates a little bit. Then comes and breaks lower again, immediate rebalance, breaks lower and drifts right into almost filling me on Friday and almost taking out that old low on the daily chart. Here's a 1 minute chart here. And I kind of like want to talk about, I got a lot of questions asking me, how did I trust that the market was going to make this type of move here after the 4 o'clock uh, regular trading hours close at 4:14? Usually, if you're a prop firm trader, you're using these monetized demo accounts, these ideas of trading past 4 o'clock. I believe, I'm not sure if it's still true, but I believe at least one of the companies were the rules what you had to be out by 4 o'clock Eastern time. And if I'm incorrect, please in the comment section correct me because I would like to know if I'm wrong. But I think the rules are you have to be out by 4 o'clock, and that's true. You never get these types of movements here, which in this case, because we're so close to that old daily low when everything's bearish, the market's going to wait until 4 o'clock close and that bell starts ringing. But then you have 15 minutes of settlement still. And then during those 15 minutes, you get to 4:14, right when the new 1 minute candle would open up. That's the closing bell. You're done. Regular trading hours closes. But electronic trading hours are still going until 5 o'clock. So you have 45 minutes still trading. And then you have that hour break until 6 p.m. Eastern time. When the market's really predisposed rather to move lower, many times it'll have this little bit of a Judas swing going into the 4 o'clock hour, and then after 4 o'clock, it really starts to accelerate into a target higher or lower. So it acts like a market on close algorithm where it knows that the majority of individuals are not participating right now. If they're day trading, they got out. They're too afraid to hold over because usually it gets real quiet and listless. It doesn't give you a whole lot of price movement. But when it's so close to an old daily low like that, and we're in a very bearish market Friday, this is when I am anticipating that type of run. So I'm going to hold on to it as long as I can, even if it's the last minute, because I've done this before where I got basically the low of the day and I was aiming for that very thing on Friday, and it just simply didn't give it to me. And it's okay. But these levels here, you can see them on the fib. If you put them on that, you're looking at it over the view of the highest wick down to that lowest wick. And that projection lower, that's negative 0.5. Then you have -1, and then negative 1.5. This is where I believe that we're going to open at or below. That's what I think we're going to aim for on Sunday's opening. It's a guess. It's not scientific. It's just a hunch. It's just experience speaking, and I'm probably wrong. So don't hold me to it. Not that you can do anything with it anyway. You can't position yourself ahead of Sunday's opening, but that's what I believe is going to happen. But I kind of like wanted to talk a little bit about that here because I know that most of you are probably prop firm traders, and you probably won't be able to participate in some of these things. And when there's earning weeks, you'll never catch these types of continuations either. And usually that's how it happens as well. But I think that's going to be it for this one. I'm kind of worn out, and I'll catch up with you, Lord willing, on Monday. Until then, enjoy your weekend and be safe.